Bring that ass back like a boom, 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 boom.
Hey, what's up everyone? This is Supernova and here with weekly overview Boom Traders August 21, week 33rd of 2022. And let's get it going. As usual, we have the session overview, risk vest model, tactical trade environment, the current market conditions, and we're going to do a summary at the end. The first thing I want to point out, since last week, our risk vest model has been showing a buy caution, so cautious buy, with some of the components of the signal being the general market is positive, up down volume is positive, new highs, new lows still neutral, and stock participation neutral. Now, arguably stock participation is the most important part of this model, so as soon as we see stock participation going to positive, we might be issuing an outright buy signal, but for now we still remain on cautious. And with some of the developments later this prior week, we might actually go into some sell caution or at least cash. Tactical trading environment still on caution, especially last 3 days of last week with Wednesday's drop. Then we had Thursday and Friday sell off. It's still on caution, so it's market highly rotational. It's selective. You can trade, but you need to exercise caution. Not that you don't have to exercise caution usually, but now it's a little bit more than usual. So that's as it pertains to our risk vest and our tactical trading environment. General word here would be caution. Now let me take you to the current markets, and we're going to take a look at the indices, how they are positioning and so forth. Then we're going to take a look at some of the nodes, sentiment. And as I said a couple of seconds ago, last but not least, we are going to do the summary. So let's dive in right into the indices. And switching to Thinkorswim platform, as you can see, this is basically my market screen. This is what I have running throughout the day when we have the markets open. I'll guide you through each of one of those, but let's first take a look at the S&P 500. I'll just zoom in a little bit. Now, we noted last week that we were at very important highs right here. That's purplish line is a 200-day moving average. So of course, we expected some pullback. That's exactly what happened. If we zoom in a little bit, you can see we just touched the 200-day moving average. That was on Tuesday. And then we had Wednesday, a gap down. We couldn't, we filled the gap, but we moved sideways. Then on Thursday, gap up very little, but we couldn't even get to the highs of Wednesday. And then on Friday, we have a gap down. Under the lows, that's the 10-day moving average, this white line. We moved below the 10-day moving average. Now I'm expecting to see some support right around here, which is 416, 417 level. That's for the S&P 500. One bad news is that we had this sell-off on Friday on elevated volume. You can see here volume is above the average, which in this case is a 20-day volume average. We have volume a little bit extended. And if you see right here at the top, these are some of the statistics for the day. That's not for the week, but that's just for the day for the S&P 500. You can see that the New York Stock Exchange up-down volume was negative. The advanced decline ratio was negative. Net highs, net lows, again, this was negative -32 for New York Stock Exchange. And we also have right here the put-call ratio for all 4 indices. So you can see that it's a little bit elevated at 0.93 for the entire market. This is getting closer to the 1 value, which in terms of put-call ratio above 1 shows that there is some hedging going on. People are buying puts to protect their positions. Now, I'm not quite sure, but let me see if I can switch this to the... Now it's still showing the same value, so I was just thinking that these labels might show the weekly values for the S&P 500, but they're still showing the Friday values. Now let's go to the NASDAQ Composite. NASDAQ Composite was unable to reach the 200-day moving average right here, as you can see. But as far as support is concerned, I'm expecting to see some bouncing right here of 322 level. We closed at 322.86 after markets. We went to 321.50. So we just did undercut those levels, and you can see this is the low of just before this gap up right here happened a week and a half ago. So we are below the 10-day moving average volume. Again, this sell from Friday was elevated, and we are heading for the 20-day moving average, this silent line. So it was expected. I mean, this rally was unsustainable in this form, but let's see if we can stop right here at the gap, or alternatively, I'm looking for some sort of support right here, those highs. This is the break of this consolidation right here. So we're looking for 306, 307 on the NASDAQ. If this gap cannot hold, last but not least, let's take a look at the IWM. The IWM was outperforming the markets. You see, it actually went above the 200-day moving average. Again, we were taken down on Friday, elevated volume. You can see also the statistics right here. You see the up-down volume and then the advance to decline. So we had 6.21 decliners to 1 advancer from this index. And I'm also looking, there are a couple of gaps right here that got filled on this drop. This is the bigger one, and I'm looking for it to see if we can find some support right here. That's at 123, 124-ish or so. So this is what I see for the indices. As far as VIX is concerned, it had a pop, and you can see right here, it had a pop into the midline, which is, these are Bollinger Bands. So it had a pop into the 20 period moving average for the Bollinger Bands, which is the midline. And usually this is the place where it is rejected. As you can see last couple of times right here, that's 2nd of August, and we had something in July, and 13 and 14 of July. If we can sustain this in terms of a pop and just drop back, then we can see the markets moving higher, but with elevated VIX, this is highly unlikely. So we need to monitor the markets for the next week. These are the two oscillators that I use. I use the Zweig breadth indicator as well. I'll show it in just a couple of seconds on the slide, but these are the two oscillators that I use based on the up-down volume and advanced decliners. Both of them, as they were in slightly overbought territory, you can see right here throughout this week. Now they're dropping and pretty much going into slightly oversold. So this is the good news. You'll see, however, the spike indicator is only in the midsection, so we might see some more downside from here on. And let me just take you to the node so you can see what I'm talking about. This is how the Zweig breadth indicator trust looks like, and here's a simple rule how to use it. Now there are two actually ways to use it. Now the first one is obviously as on market oscillator, ranging between overbought and oversold levels, and as such we have 65 and 35 as the two extremes. So anything above 65 is extremely overbought, and anything below 35 is extremely oversold. There are also two sub-levels, which are the 40 and the 61.5. Now, don't ask me why is the 61.5. This is how it's used. I'm just, giving you the raw information here. So mildly overbought is 61.5 and above, and mildly oversold is below 40. And the other way that this indicator can be used is if we go from below 40 to above 61.50 in 10 days or less. This is basically activating the thrust, which suggests a very, very bullish market for the year ahead. Now, this has happened a couple of times for the last years, and we can pinpoint with some certainty that this is the case and the indicator works, but I prefer to use it just as an overbought and oversold levels for the market. And as you can see in the latest rally right here, we hit the 65 zone, and now we are just screaming down. As I told you last week, we are overbought on those indicators, mine as well, that are based on the advanced decline number of stocks and the advanced decline volume. We were overbought. Now we're getting to a midsection here on the Zweig breadth thrust indicator and to oversold levels on my indicators. So we'll see how this one goes. I also want to point out a couple of things in terms of my notes. We're still on the recession topic, and I think this is the one that's been captivating minds of pretty much everyone so far. We have the ECRI weekly leading index, which is WLI from the advisor perspectives. Last week we had it at minus 13.2, so now we are, as you can see right here, we're curling back a little bit up. Although we are still below levels that are recession associated, these shaded areas here. From 1965 we had 8 of those, and a couple of those times we were below the levels that we currently are, but in general we are pretty low. And this is also confirmed by this chart. Now let me just explain what this chart is all about. It's again from the advisor perspective, so it's pretty much the same thing, but here are the things. Now the first thing that it's important to know is this little red dot. This is when recession starts, each of those shaded areas. And the blue line indicates the year-over-year weekly leading index. Now, as you can see, year-over-year, we had minus 1.1, minus 1.7, 4, 1.3, minus 5.7, so forth, so forth. The only time in history when the year-over-year weekly index has been below the value we have it right now. Right now we have it at minus 6.5. The only other time in history when we had it was minus 7.4. That was in 1970. So we are extremely low, and we still don't have like a shaded area for recession. So granted, we are pretty much in recession according to those indicators. Now, there are also some news about companies laying off people, slowing down new hiring process and stuff like that. So it's pretty much a given that we are in a recession right now. Also, I want to point out the cycles for NASDAQ, S&P 500, and Dow Jones, starting with NASDAQ. As we saw even last week and before that, Tintin has been going over these topics. We do have cycle work suggesting another undercutting of the lows late September, beginning to mid-October, and then rallying off for the end of the year. S&P 500 suggests that we are not going to undercut the lows. And Dow Jones Industrial do have another low right here, which, just from a standpoint perspective, looks like it's September to October, and then rallying into the third year of the presidential cycle. As you can see right now, we're in the second year of presidential cycle, which is usually the worst year for markets, and going into the third year. I don't have much more in my notes. I just don't want to bore you guys with random information. One thing that it's going around news in Europe is the situation with the nuclear power plants in Ukraine under the Russian siege. There's been, news streams coming from pretty much both propaganda campaigns coming from Russia that the Ukrainians are trying to sabotage the nuclear power so the Russia looks bad, or Ukraine's also saying that, Russia is trying to cut off all energy supplies for Ukraine so that the country can, basically declare that it has lost the war, so forth and so forth. So it's news are coming both ways. You don't really know what's happening, but one thing that it's important to know is that people are getting stressed out a little bit about this nuclear power plant, because this Zaporozhye power plant is the biggest one that's in Europe, and if it happens, it might go down as another catastrophe like Chernobyl in 1986. So this is one of the things that has been captivating the news sources in Europe. Now let's look at the sentiment, starting with the American Association of Individual Investors. Now they're looking 1 week back, so note that the last week that they have information for, it's 17th of August, and we've been seeing some bullishness coming into the markets. I'm thinking that next week we're going to see a bit of a change, sharp change, maybe with Friday events in the markets, but so far so good. Bullishness is coming back into the markets. The fear and greed index from CNN, you see it's neutral, 51. Last week we had it at 54, I believe, so it's a little bit of a drop, and Bitcoin has been going back into almost the extreme fear, below 25. It's 27 right now. As price dipped a little bit the last couple of days. I'm not going to go into the strong groups, strong sectors. If you're really interested into that, please join our Discord server where we do a marvelous analysis of the strong industry groups on Monday. And also we post our best looking charts for the week ahead, where you can see some of the groups that are forming. So this is something that you can get into if you join our Discord server. Last but not least, looking at the summary, again, risk vest is on buy, but caution out. Some of the oscillators that we use for market timing have turned down, so we might even switch that during the week, depending on how the week looks like. Setups, selective at best right now. Not a lot of new setups showing up, and here's a little tip. The growth stocks, if you look at ARK investment funds, and if you look at some ETFs like SARK, S-A-R-K, this is short ARK, so basically inverse ETF for the ARK. SARK is looking poised to go up, so this is something that you can use as a hedge if you don't want to sell short or buy puts. The market is testing now, tested the 200-day moving average on the S&P 500. The IWM rejected, going down. Nasdaq was not able to go there. Put volume is neutral to slightly elevated volatility. From calm, we went back to neutral, with VIX touching the midline and values of around 20. And another topic that is interesting, as I said, looming recession, as well as the nuclear crisis that is going over in Ukraine with the Russian invasion. So be careful when you're trading. If you need to step away from the computer a little bit, let the markets resolve themselves so you have a clear perspective of what to trade, what not to trade. But from what we can tell from our portfolio and our analyst portfolios, selective is the best advice that you can get. Defensive stocks are doing so far so good. Growth, not so much. So I hope this was interesting and informative for you. I hope it helps you in your trading decisions for the next week. If you want to know more about the markets, please join our amazing community. We have a lot of people trading there, a lot of really knowledgeable people that will help you with your trading and be with you on this amazing journey that trading is. So if I don't see you in our Discord server, I'll see you next week here. Up until that time, trade safely and see you there. Bye bye.